Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. So, I mean, I want you to imagine finding the greatest, most world-changing technology company on Earth.
Okay.
Like a company that completely dominates its industry. It has a brilliant product, and it is just absolutely guaranteed to shape the entire next decade of the global economy.
Yeah.
Now imagine putting your hard-earned money into that company and, well, losing almost everything.
Yeah. I mean, it sounds completely impossible, right? Because the fundamental assumption that most of us carry is that a phenomenal world-changing company automatically makes for a phenomenal investment.
Right, exactly.
But the underlying mechanics of the market, they actually operate on a completely different set of rules.
And that paradox is really our mission for today's deep dive. We're going to explore why buying the absolute best, the most popular assets can sometimes be the single most dangerous financial move you can make.
It really can be.
So to unpack this, we're looking at some fresh July 2026 financial analysis from Reuters and the Financial Times. And we are also going to view that data through the lens of a true market veteran, which is Oaktree Capital's co-founder Howard Marks.
Yeah, his foundational 2025 memos on Bubble Watch and the calculus of value, they were written to warn investors about this exact illusion.
And, for American investors right now, navigating the U.S. economy here in 2026 under President Trump, things are moving incredibly fast. It requires a very solid framework to see through that illusion.
Absolutely. I mean, the speed at which capital is moving right now is just staggering.
So for you listening, whether you are trying to make sense of artificial intelligence or quantum computing or, the U.S. credit market, having a great long-term narrative doesn't mean you should blindly hit the buy button.
No, definitely not.
And I think the best place to start untangling this is the core philosophy Marx lays out regarding asset quality versus asset price.
Yeah, so the foundational rule he operates on is simple, but it's really profound. It's not about what you buy.
Okay. It's about what you pay for it.
I want to test this logic a bit because, on the surface, it feels a little backwards to a beginner.
Sure.
If I buy shares in a tech giant with incredible products and massive revenue, I mean, I own a piece of a great company. How does that ever become dangerous?
Well, it becomes dangerous when the price you pay completely detaches from the actual value of the business.
Right.
Marx argues that a world-class asset becomes a toxic investment if it's priced too high. And the reverse is also true. A struggling out-of-favor company can actually be a fantastic investment if the price is just low enough to compensate for the risk.
So price means nothing in a vacuum.
Exactly.
Yeah.
It only matters in relation to value.
It feels a lot like buying a house.
How so?
Well, if I find
Yeah.
this sprawling, beautiful mansion in the safest, best neighborhood in town, there is no debate, right? That is unequivocally a good asset.
Oh, absolutely. But if the true market value of that property is, say, $500,000,
Right.
and I let a massive bidding war push me into paying $2 million.
You are financially underwater the second they hand you the keys.
Exactly.
I mean, the physical house is still gorgeous, the neighborhood is still great, but the investment itself is a total disaster. You paid for perfection, plus a massive premium, which just leaves no room for a return.
And if the roof leaks or, the market cools down, I have zero cushion.
Right. Which is the essence of Marx's calculus of value. In the short term, market sentiment is driven almost entirely by human emotion, fear, greed, the hype of a new technology.
Yeah.
And that emotion can drive prices wildly far away from their intrinsic mathematical value. But over a long enough timeline, economic gravity always takes hold.
Wow, economic gravity. I like that.
Yeah, and high prices that exceed actual value, they eventually face this crushing downward pressure.
While low prices that are sitting below value eventually get recognized and have upward potential.
Exactly.
So if we take that mansion analogy and we drop it into the absolute most expensive neighborhood in the 2026 market, we really have to talk about artificial intelligence.
Well, we definitely do.
Here's where it gets really interesting, right? Because AI is obviously a massive structural growth theme. It is actively changing everyday industries. So the common sense thought process for a beginner is just, well, buy into AI at any cost, because the future growth will eventually cover whatever premium I pay today.
And that thought process is the exact trap we are talking about. It confuses industry analysis with investment judgment.
Wait, meaning I might be right about the industry, but completely wrong about the investment.
Yes, precisely. Industry analysis is observing that, hey, AI will change the world and generate billions.
Which is true.
Right. That is likely true. But investment judgment requires asking a much harder question. Is the current massive price of these AI stocks still cheaper than all that future growth?
I see.
Knowing the future just isn't a competitive advantage if millions of other investors already know it and have already priced it into the stock today.
So if perfection is already priced in, any slight bump in the road causes the stock to just plummet.
Exactly.
And looking at the latest data, that bump in the road is already here. According to recent analysis from Reuters on July 24th, 2026, even the absolute giants of the industry, companies like Alphabet and Tesla, they're recording negative free cash flow.
Which is a really remarkable metric to see from companies of that immense scale.
Let's break down why that matters so much for the listener. Negative free cash flow means that despite these companies pulling in billions of dollars in revenue from ads or cars, the actual cash going out the door to buy servers and build data centers and run AI models is greater than the cash coming in.
Right. They are literally burning money to build the infrastructure of the future.
And that cash burn is creating palpable doubt in the market. The industry calls these massive cloud and computing providers hyperscalers.
Yeah, and there's growing concern right now that these hyperscalers are deploying capital at a rate far faster than the technology can actually monetize.
Wow.
They are buying tens of thousands of highly expensive graphic processing units, or GPUs, which require massive cooling centers and tremendous amounts of electricity.
So the theme is undeniably good, but the physical price tag to build it is just astronomical.
Yeah. And when you pair a great theme with an astronomical price tag, and then you add heavy debt to finance it, the risk profile shifts dramatically.
Right.
The market is pricing these tech companies as if their AI investments will be flawlessly, endlessly profitable starting tomorrow.
Which is a huge assumption.
Exactly. If that profitability takes 5 years instead of 1 year, the math breaks down. And the investor who bought at the absolute peak takes the hit.
So if these hyperscalers are spending billions of dollars in cash to build this infrastructure, that money has to come from somewhere.
That does.
Which kind of pulls us out of the stock market and right into the credit and debt markets.
And this is where the risk gets hidden from the average observer. According to recent reports from the Financial Times, we are currently in the middle of an unprecedented AI debt boom.
Really? Unprecedented.
Yeah. Major investment banks like Morgan Stanley, they are structuring incredibly complex debt deals. They are raising billions by using data centers, GPUs, and long-term computing contracts as the actual collateral for the loans.
Let's pause on that because using a GPU as collateral sounds uniquely risky to me. If you use a building as collateral, the building is still there in 20 years.
Right.
But if you use a computer chip as collateral, the technology moves so fast that the chip might be completely obsolete e-waste in, 36 months?
Yeah, that depreciation risk is severe. But the recent FT analysis points out an even more critical danger regarding who is actually holding the bag.
Okay, what do you mean?
Well, the credit risk, the actual danger of the loan defaulting, is being quietly shifted. It's moving away from the massive cash-rich hyperscalers and being pushed down onto much smaller, cash-poor AI research labs and localized independent data center operators.
So what does this all mean for the everyday person? It sounds a bit like co-signing a car loan for a friend.
Oh, that's a good way to put it.
Like the car itself, which is the AI technology, might be fantastic. But if I co-sign a loan for a friend who doesn't have a steady paycheck, the quality of the car doesn't matter.
No, not at all.
I'm on the hook when the payments come due. It's entirely about the terms of the contract and the financial health of the person making the payments.
That analogy perfectly captures the structural risk here. If you are an investor buying into what you think is safe AI infrastructure debt, assuming it's backed by the biggest tech giants in the world, you might be very unpleasantly surprised.
Because you're not actually holding their debt.
Exactly. You could actually be holding the debt of a small, unproven research lab. And their only collateral is a warehouse full of depreciating computer chips.
But investors are just flocking to this debt anyway because it pays a high interest rate. Right. They see a high yield and just assume the return is worth it.
They do, and this circles right back to Howard Marks's lessons on value. A high interest rate or, a high coupon on a bond is completely irrelevant if it doesn't actually compensate you for the real risk of default.
So you have to look at risk-adjusted returns, not absolute returns.
Precisely.
Which brings up a really confusing data point from the broader market. If we look at Reuters data from July 23rd, 2026, the high-yield bond market, which is what we used to call junk bonds, actually looks reasonably safe on paper right now.
Right.
The spreads are lower than their historical averages.
And we should probably define that spread for a moment for everyone listening.
Please do.
It's basically the difference in the interest rate between risky corporate debt and ultra-safe government debt. Normally, a low spread implies the market feels very confident that corporations will pay back their loans, so they just don't demand a massive premium to take on the risk.
So the data says the market feels safe. But based on everything we've just discussed about AI debt, that sense of safety seems completely distorted.
It is entirely distorted, and that's because the composition of the high-yield index has fundamentally changed.
How so? Like, what changed?
Imagine a basket that used to be filled mostly with highly risky, unstable companies.
Okay.
The average interest rate of that basket would be very high. But recently, a large number of higher quality, lower risk corporate bonds have been added to that exact same basket.
Oh, I see.
Maybe they were downgraded from investment grade, or maybe issuance patterns just shifted. But because these safer bonds are now in the basket, they drag the average yield down.
So the overall index looks safer and lower yielding just because of these new additions.
Exactly. But if you bypass the safe ones and buy the other half of the basket, the highly risky AI debt, you are taking on massive default risk. The average is hiding the danger. The terms of the deal don't protect you, the collateral is weak, and the cash flow is poor. In that specific scenario, getting a 10% yield is actually a terrible investment.
So if the underlying mechanics are this warped, what happens when billions of dollars chase these exact same hot trends? I mean, we're seeing unprecedented amounts of money pouring not just into AI debt, but into private credit.
Yeah, the private credit boom is where the illusion of liquidity becomes the most dangerous factor in the market right now.
Okay.
Howard Marks wrote a memo in April 2026 addressing this exact phenomenon. Over the last 15 years, a historic amount of capital has flooded into direct lending.
Just to be clear for the listener, private credit is essentially non-bank lending, right?
Right.
It's wealthy investors or massive funds lending money directly to corporations, completely bypassing traditional regulated banks.
Correct. And Marx points out a very predictable, deeply human pattern when these new markets form.
Yeah.
Well, early on, the pioneering investors get fantastic deals. They get great terms, high returns, and really strong structural protections because capital is scarce.
But then the success stories start making headlines.
Exactly. And that triggers a flood of late money. As more and more investors rush in, desperate for those exact same returns, capital is no longer scarce. It becomes abundant.
It really reminds me of a hot new nightclub opening in the city.
Okay, I like where this is going.
Well, early in the evening, the bouncers are incredibly strict, right? They check every ID, they enforce the dress code, and the room inside is spacious, the vibe is great, everything is manageable.
It's good terms, high returns.
Exactly. But as it gets late, the massive crowd shows up. The line wraps around the block, and everyone wants in. So, to accommodate the demand, the bouncers simply give up.
They stop checking IDs.
They completely stop. The standards vanish, the room gets dangerously packed, and the entire dynamic of the venue shifts. And crucially, if a fire breaks out, the room is so over capacity that nobody can actually find the exit.
That is a brilliant way to conceptualize market liquidity. When late money floods into private credit, lending standards loosen. The bouncers just stop checking IDs.
Yeah.
The price of the assets goes up, the terms of the loans get weaker, and the risk of catastrophic loss spikes because everyone is crowded into the exact same trade.
And the authorities are actively watching this nightclub fill up right now. Recent data from Reuters shows that European financial stability regulators are heavily scrutinizing the shadow lending industry, which is this private credit market.
Yeah, there.
I mean, we are talking about a $3.1 trillion industry operating largely outside traditional banking oversight.
Trillion with a T. And the internal flows within that 3.1 trillion are shifting in a way that, frankly, should alarm any investor.
What's happening there?
Well, Reuters reported that wealthy, agile individual investors are actually starting to pull their capital out of private credit. They are getting spooked by the lack of liquidity.
Meaning they are realizing that if the market turns, they can't easily sell these private loans to get their cash back. They are trapped.
Exactly. They see the fire hazard and they were heading for the exit. Yet at the exact same time, massive, slow-moving institutional money, like large insurers, they are jumping in even deeper, just chasing the yield.
So the smart money is quietly slipping out the back door while the massive institutions are still fighting to get in the front.
Yeah.
That structural setup has historical precedent, doesn't it?
It definitely does, and Marx draws a very direct line between these dynamics and the lessons of the 1929 stock market crash.
The crash that ignited the Great Depression. What are the specific parallels he sees in today's market?
Well, he isolates a specific triad of risk, three ingredients that, when you combine them, create structural collapse.
Okay, what's the first one?
The first is selling inappropriate, highly complex financial products to investors who don't actually understand the underlying mechanics.
Like packaging AI data center debt backed by appreciating computer chips and selling it as a safe, high-yield product.
Exactly. The second ingredient is excessive leverage, borrowing money to magnify your investment returns, which simultaneously magnifies your losses.
Right.
And the third, which he argues is the most lethal, is an asset-liability mismatch.
What does that mean in simple terms?
This means buying illiquid, long-term assets using short-term borrowed money.
Wow, that is a terrifying combination.
It really is.
If you borrow cash that you legally have to pay back next month and you use it to buy a private loan that you can't sell for 5 years, I mean, all it takes is one margin call.
Yep.
If the market dips and your lender demands their money back today, you are instantly bankrupt because you literally cannot sell the asset to pay them.
And that exact triad of risk is alive and well right now in 2026. We see it in the AI debt structures. We see it in the $3.1 trillion private credit market. And we see it heavily in retail products like leveraged ETFs.
Let's actually define a leveraged ETF really quickly so you, the listener, understand the danger there.
Sure. A leveraged exchange-traded fund uses daily borrowed money to try and double or triple the daily return of a specific index or asset.
So if the asset goes up 10%, my fund goes up 30%.
But if the asset drops 10%, you lose 30%.
Ouch.
Yeah. And because the fund has to rebalance its borrowed money every single day, it is the ultimate example of using short-term funding for long-term investments. If the market experiences a severe, sudden freeze, the math underpinning those funds can completely collapse.
Okay, so we've outlined a market that honestly feels like a minefield. Good stories are masking bad math, massive debt is hiding behind complex structures, and the exit doors are getting really crowded.
That's a fair summary.
If you're a beginner investor listening to this, how do you actually build a defense?
It requires completely redefining how you view limited risk.
Okay.
Most people think limited risk means a guarantee of no losses, but that doesn't exist. True limited risk means having a verifiable structural safety net in place. It means ensuring that when things go wrong, and they eventually will, the size of your loss is contained.
So what does that safety net look like practically? If I'm looking at my stock portfolio, what are the actual mechanisms that protect me?
In stocks, your primary downside protection is low valuation, not paying a massive premium for the hype.
Okay.
Second, you look for companies with net cash on their balance sheet.
Meaning they have more actual cash sitting in the bank than they have outstanding debt.
Yes, that cash acts as a shock absorber.
That makes sense.
And finally, you look for recurring, predictable revenue. If a company doesn't need to borrow expensive money to survive a recession, their stock might dip, but the company won't evaporate.
So buy solid businesses at cheap prices. But what about the bond and credit side?
In bonds, your safety net is entirely about the legal structure of the deal. You want senior status. If the company goes bankrupt, the senior debt holders are the very first people legally entitled to get paid back from whatever assets are left.
Got it.
You also want strong, non-depreciating collateral. And you want short maturities, basically lending money for a short period, so your capital isn't locked up blindly in a rapidly changing world.
There is one final asset class we need to discuss, and it's one that gets aggressively villainized in financial media. Cash.
This is perhaps the most powerful paradigm shift an investor can make based on Marx's philosophy. Cash is constantly portrayed as a missed opportunity.
Right. The narrative is always that sitting in cash means you are losing purchasing power to inflation, or you are foolishly missing out on the AI boom. You are just failing to optimize your portfolio.
But that narrative ignores the value of optionality. Cash is not a drag on your portfolio. Cash is an admission ticket.
That is a huge aha moment. You keep that admission ticket in your pocket so that when the market inevitably overextends itself, when the nightclub catches fire and the panic sets in, the prices of incredible assets crash.
Yes, exactly.
Suddenly, everything goes on a massive sale. And because you hold cash, you are the one who gets to walk right in and buy the beautiful mansion for absolute pennies on the dollar.
Because without cash, you have no liquidity. You are completely powerless when the absolute best opportunities arise.
Yeah.
If 100% of your money is tied up in the hottest, most expensive AI theme and the market turns, you just cannot buy the dip. You are trapped holding illiquid, depreciating assets. Cash gives you the ultimate power in investing.
The power to wait.
Exactly, the option to act only when the conditions heavily favor the buyer.
So as we bring this deep dive to a close, let's distill this into a tangible checklist for you, the listener, to apply to your own financial decisions today.
Sounds good.
First, separate the asset from the price. Are you buying a great company, or are you buying at a great price? Because a world-class company bought at an exorbitant premium is a mathematically terrible investment.
And second, interrogate the terms of the deal. Does the yield or the interest rate you are being offered actually compensate you for the true underlying risk?
Right.
Don't just look at the high return. Look at who is really holding the debt, what the collateral is, and what legal protections you actually have if they default. And third, where is your safety net? Are you heavily leveraged, or do you have structural downside protection? And most importantly, do you have enough cash, that magical admission ticket, to take advantage of future chaos instead of becoming a victim of it?
I want to leave you with a final thought to ponder as you review your own portfolio, especially if you find yourself feeling the fear of missing out on the current tech frenzy.
Let's hear it.
In a market where every single investor is desperately pouring their money into the exact same guaranteed future technology, ask yourself, if everyone has already bought in, who is left to buy it from you when you want to sell?
Don't forget to subscribe and hit that like button.